Welcome back to Factful Finance, where we empower you to take control of your money with expert insights that make complex topics easy to understand. Today, we're diving into something that often sounds more complicated than it really is. But trust me, once you get the hang of it, it will change how you view the economy: the yield curve. Have you ever wondered how experts predict a recession, or how they know when things are about to heat up in the market? Well, one of the most powerful tools in their arsenal is the yield curve. But what is it exactly? And what can it predict about the economy? Let's break it down. The yield curve is a graph that shows the relationship between interest rates and the time to maturity of government bonds. In simpler terms, it compares the return you'll get on bonds that mature in the short term versus the long term. And here's the kicker. It tells us a lot about what's going on in the economy and even more about what's coming next. Now you might be thinking, okay, sounds interesting, but how does this actually affect me? Great question. Understanding the yield curve helps you predict economic downturns, gauge the health of the financial system, and even understand how the stock market might behave. Let's talk about the three most common types of yield curves: normal, inverted, and flat. A normal yield curve is what you want to see. It shows that long-term bonds offer higher interest rates than short-term bonds. This is because lenders demand more return for locking their money away for a longer period, as they're taking on more risk. A normal curve suggests that the economy is growing steadily and everything is on track. Then we have the inverted yield curve. This is where things get interesting and a little scary. When short-term interest rates are higher than long-term rates, it suggests that investors are expecting economic trouble ahead. They believe the economy will slow down, so they're willing to lock in lower returns for long-term bonds. Historically, inverted yield curves have been a reliable signal of recessions, sometimes up to a year in advance. Scary? Yes, but also useful if you're prepared. And then there's the flat yield curve. This is the gray area. A flat curve usually happens when there's uncertainty in the market. It might suggest that the economy is transitioning, but no one really knows where it's going. It's like a warning sign. Things could go either way. Now, let's talk about real-world implications. Let's say you're like Noah, a small business owner who's planning to expand. If the yield curve is normal, he might feel confident about borrowing money for a long-term investment because the economy seems stable. But if the yield curve is inverted, he might think twice. An inverted curve could indicate that borrowing costs might rise and the economy could slow down, affecting his business. And we've seen this in action. In 2007, before the 2008 financial crisis, the yield curve inverted, giving economists and savvy investors a heads up that something was off. Fast forward to today, and many financial analysts keep a close eye on the yield curve for similar signs of warning. But remember, it's not always 100% accurate. It's just one piece of the puzzle. The yield curve might predict economic slowdowns, but it doesn't tell us exactly when or why. So how should you use this knowledge? First, stay informed. Pay attention to how the curve shifts and what experts say about it. Then, make decisions that help protect your finances. If the curve is inverted, it might be time to review your investments, adjust your portfolio, and prepare for some turbulence. On the flip side, if the curve is normal, it's a great time to look for long-term investment opportunities. And before I wrap this up, a quick reminder. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. So, what's the takeaway here? The yield curve is more than just a graph. It's a powerful tool that can help you understand the economy, anticipate market trends, and make more informed financial decisions. Keep an eye on it, and it could be the key to navigating both calm and stormy economic times. Which part of the yield curve did you find most interesting? Let me know in the comments. If you want more insights like this, hit the like button and make sure you're subscribed so you don't miss out on future financial breakthroughs. If you found this helpful, you'll want to check out the next video on how interest rates affect your personal finances. Click the video on screen now.